expectations, with the first half 2023 revenue and PATMI coming in at 46% and 32% of our full year 2023 forecasts. It was lower generally because the first half is usually weaker for Airbnb, and we expect earnings to rebound strongly in the second half, mainly driven by the strong summer travel demand as well as through high operating leverage. So moving on to the positives, would like to highlight three key travel trends. First of all, the international travel is accelerating, particularly to the Asia Pacific regions like Japan and South Korea. So the number of cross-border trips, they grew by about 16% year over year, and the cross-border bookings, they contributed about 48% of the total bookings volumes. Secondly, travelers, guests, they are returning back to cities. Like the urban travel bookings, they grew by about 13% year over year. And lastly, long-term stays remained resilient. Stays particularly above 28 days, they contributed about 18% of the total bookings volumes. And this is mainly because of flexibility granted by remote work environment. Moving on to the second positive, the company, it continues to have active listings at record high levels. They grew by about 19% year over year to 7 million listings in the second quarter. And this is mainly because of ongoing product improvements and marketing initiatives to attract hosts. Like for instance, in May, as a part of its summer release, it introduced about more than 50 features, and this includes Airbnb rooms and monthly stays. So moving on to the negatives, booking volumes, in the second quarter, they grew by about 11%. However, this is a slower as compared to 19% growth in previous quarter, in the second quarter of 2023, and as compared to 25% in the second quarter of 2022. And the slowdown, it was mainly because of tough comparisons. Like for instance, in the second quarter of 2022, the company, it had witnessed pent-up demand after the Omicron variant. There were restrictions in the first quarter, so the guests could not travel, and as a result, that led to a pent-up demand in the second quarter of previous year. So moving on to the outlook, for the third quarter, company expects revenue to grow by about 14 to 18%, and also the bookings volumes, it expects the year-over-year growth rate to improve sequentially. And in terms of its full year guidance, it expects its adjusted EBITDA margin to be slightly higher as compared to its previous year of 35%. So in terms of its valuation, we have downgraded the stock to accumulate, mainly because it has recently jumped up. And we have also increased our target price from $143 to $152, mainly because we have increased our revenue and PATMI by 3% and 8% to account for a higher daily rates, listing prices, and also because of higher interest income. So overall, for Airbnb, we believe that it's well positioned to benefit from shift to alternative accommodations, mainly because it has a unique supply base of 7 million, and also it benefits from the guests who want to stay longer. And also it's more family and group friendly. So moving on to my next counter. Next, thank you. So next slide, please. So we also released our blog second quarter earnings results last week. So overall, the revenue, first half revenue, it beat our expectations by 3%. However, the net loss was worse than expected at 77% of our full year forecast. And this was mainly because of the lower gross margins. So in moving on to the positives, the block, it's basically a fintech company, and it has two segments, Cash App and Square. So Cash App, it's a peer-to-peer payment service and also banking services. So the Cash App gross profit, they grew by about 37% year over year, and this was led by the 15% growth in its users, as well as strong adoption of its banking services like debit card and also crypto trading. So moving on to the second positive, it witnessed its improvement in its net loss. So its net loss improved from 208 million in the second quarter of 2022 to 123 million net loss. And this was mainly because of a high operating leverage, like lower headcount growth, and also lower sales and marketing expenses. For instance, in the full year of 2023, it expects headcount growth of below 10% as compared to 46% headcount growth in the FY 2022. So moving on to the negative, Square, which provides a point of sale solutions and payment solutions to merchants. The Square segment, it witnessed a payment volume growth of about 12% on its platform. And this is lower as compared to 17% in the first quarter of 2023 and 25% in the second quarter of 2022. And this was mainly because of slower consumer spending as well as weaker e-commerce trends. Moving on to the outlook, for the third quarter, company expects consolidated gross profit of about 21% year over year. And this is mainly driven by the Cash App segment, which it expects to be growing by about 27% year over year, and Square segment by 15% year over year. So in terms of profitability, company it increased its adjusted EBITDA outlook by about $140 million so it now expects about $1.5 million for adjusted EBITDA for the full year of 2023. So moving on to the valuations, we maintain a buy recommendation. However, we have lowered our target price to $83, and this is mainly because we have increased our net loss by about 12%, and mainly because to account for lower gross margins. So overall, the unique proposition for Block, this is mainly because we believe that it targets lower income and underbanked demographic, as well as it should benefit from the ongoing digitalization of payments. So that's all for Block. I would now pass on to Glenn for OCBC. Sorry, Max.
Thanks, Amrish. So we published our reports on Amazon second quarter results. Overall, the results for the second quarter, the revenue was in line, but the earnings has exceeded our expectations. The first half revenue in PATMI was at 47% and 68% of our full year 23 forecast. Jumping straight to the positive, firstly is that revenue beat company guidance. So for the quarter, the overall revenue grew by 11% year on year to $34.4 billion. And this was above the top end of company guidance of $133 billion. So the better than expected performance was mainly driven by the re-acceleration of growth in international segment, as it grew by 9.7%, which is quite a significant re-acceleration, as it was only up by 1% during the first quarter. Then advertising was also, which is part of the retail business, continues its strong growth at 22%, and it also experienced a slight re-acceleration from the 21% in the first quarter. As for the AWS, it was up by 12%. Again, slightly better than company expectations of 11% guidance. Which brings me to my second point, which that is AWS growth seems to be stabilizing. So for the past few quarters, AWS growth has been decelerating because customers are optimizing their costs, which means that they're opting for lower tier products and they are cheaper. But right now, Amazon says that it is seeing some customers starting to shift their focus away from cost optimizations to new workload deployments. So management said that they are seeing this trend to continue in Q3, and therefore they think that this cost optimizations is going to shift it further, which means that the proportion between the customers who continue to optimize the cost and customers who wants to deploy new workloads are going to shift again for the second half to increasing customers deploying new workloads. So because of this, we think that there's a possibility of re-acceleration of growth in the second half, mainly due to the fact that Amazon is releasing some new AI services at the end of the year, and also this is in time with the current customers' efforts as they increase their computing spending. And then lastly, thirdly, I guess is the main highlights of the call, which is that the efficiency enhancements initiatives are driving a higher operating leverage. So both gross margin and operating margin expanded by around 300 basis points year on year. And this is mainly due to the fact that Amazon is seeing easing inflation headwinds, including like your fuel prices, your freight prices, and line haul rates. So this ultimately also reduces the cost to serve, which is essentially your delivery cost. And Amazon is also experiencing benefits from their headcount reductions, which fell by 4% or about 62,000 employees. So yeah, it's quite significant. And then they are also incurring a lower capex during the period. For the efficiency enhancements, the regionalization efforts is also bearing their fruits, as it managed to reduce the number of touches for each packages by 20%, as well as the miles traveled by each package by 19%. So this resulted in a lower transportation cost because again, lower distance delivery cost less, and it also results in a faster delivery. Then lastly for the positive is that they generated a strong free cash flow of trailing 12-month FCF $7.9 billion. And this is actually the first FCF since the third quarter of 2021. And the positive free cash flow is mainly because they generated a higher operating income as well as incurring a lower capex. Next slide, please. So yeah, for the negative, we didn't really found any negative during the call. So I'll jump straight into the outlook. So for the third quarter, Amazon has guided for revenue growth between 9 to 13% year on year. And as a side note, this is taking into account the recent Prime Day that took place last month. And then again, as I mentioned just now, AWS growth seems to have bottomed out. And we think that there's going to be a slight re-acceleration. There's a possibility of a slight re-acceleration in the second half. In terms of capex, the company thinks that they're going to spend about $50 billion for this year, which is about 15% lower than the $59 billion that they spent last year. The majority of the cut will come from the investments in building out their fulfillment and transportation networks, and they will increase their investments on AWS, particularly for generative AI infrastructure. So for our valuation, we upgrade to a buy rating at a target price of $175. And this is using a WACC assumption of 6.4% and terminal growth rate of 5%. In terms of our forecast, we maintain our FY23 revenue assumption, but we increase our PATMI forecast by 39% to take into account the higher than expected margins as well as the lower capex. So yeah, that's all for Amazon. Now I hand over the time to Jonathan. Thank you.
Thanks, Max. Good morning, everyone. So I'll just run through the FAANGM's performance for July. Overall, the FAANGM was actually the laggard amongst the S&P and the Nasdaq, so it was only up about 2.9% for July. The real gainers were digital ad companies like Meta and Alphabet, which were up 12% and 10% respectively, after issuing better than expected forward guidance during their second quarter earnings call. Next slide, please. Just a quick recap on the results for each of the FAANGM companies. Overall, FAANGM revenue grew about 7%, so it was sort of a slight re-acceleration compared to the first quarter, where it was only about 3%. Only Apple actually saw a revenue contraction due to weaker iPhone, Mac, and iPad sales. In terms of how revenue compared to company guidance, only Netflix actually missed guidance for its second quarter revenue by a little bit, so it only missed by about 0.2%, which is relatively in line. But the bigger thing was that adjusted PATMI or adjusted earnings actually spiked about 17% year on year, which is quite significant because the last quarter earnings were actually down. So the FAANGM as a sector saw about a 20% sequential year on year improvements during this second quarter. Amazon stood out with 90% year on year spike in adjusted earnings, as Max just mentioned, mainly because of the top line growth as well as lower logistics costs. Next slide, please. Moving into our individual counters, I won't run through the earnings since we already covered that. But for Meta, they actually launched their new, Twitter killer that they're calling it, Threads, which is their new short posting text app. So in the first few days, they saw about 100 million new users, which roughly equates to about 40% of total users on Twitter. Right now, it's called X. Most of the users were actually coming from Meta's other family of apps, so like Instagram, Facebook, or WhatsApp. And we think that for Threads, it's quite an interesting proposition for Meta because there's a lot of potential here in terms of an additional revenue source. At the same time, the risk is very low because the team that's working on Threads is a very small team and they haven't really put a lot of money into it as of yet. So still in its early days, but we think that it could be significant advertising revenue generated from Threads if it picks up further. Moving on to Alphabet. Alphabet actually saw quite a sharp increase in its domestic shipments of its Pixel smartphones. So 48% is quite significant. One of the main reasons is because they launched their new Pixel Fold smartphone as well as a new Pixel 7a, I believe, which is their lower cost smartphone. What's also very surprising is that actually the total Android phone shipment in the US fell 38% in the second quarter. At the same time, iPhone shipments were also down about 6%. So it's quite significant that everyone else is falling, whereas Alphabet saw quite a large increase in its domestic shipments. Signifying that there is a little bit more popularity in terms of how users are viewing the Google Pixel phones. Even though revenue right now for Pixel phones doesn't really contribute that much, I believe it's like about 6 or 7% of total revenue. We do think that this could be also another significant growth opportunity, especially in the lower cost smartphone markets in other regions outside of the US. Moving on to my last counter, which is Netflix. So Hollywood actors actually officially went on strike in July. So they reportedly left about $100 billion, a deal worth about $100 billion on the table, worth of wage increases, pension and health contributions, as well as residuals. The main thing the main reason why the actors actually went on strike is because of its likeness and imagery that I guess they're worried that AI will basically take their jobs, because right now I believe their contracts, the Hollywood studios have all the they basically sign away all their rights and images to Hollywood studios. So essentially, if you leverage on AI, you can kind of replicate a lot of these actors in movies in the future. So right now, what they're really worried about is protecting their own jobs. At least not in the immediate term, but in the nearer mid to near term, when especially as generative AI is starting to pick up. When it comes to streaming, as a percentage of total US TV time, streaming rebounded slightly to 37.7% of streaming time. Most of this was actually due to it's kind of the holiday season over there, the summer period. So streaming actually accounted for about 90% of increased entertainment usage for kids aged 2 to 17 years old. Essentially all your kids, they're out of school and they're just kind of going on streaming websites for entertainment. Netflix remains second in terms of all streaming platforms at 8.2%, slightly behind Alphabet's YouTube at 8.8%. So that's all for my counters. I'll hand it back to Max to cover Apple and Amazon. Thank you.
Thanks, John. For Apple, the news is that it is reportedly testing an in-house developed generative AI tools, and it is said that this tool is kind of similar. Works like it functions similar to the OpenAI's ChatGPT as well as Google's Bard, and then some engineers are actually said to be testing a chat box, and they actually call it as Apple GPT, but we're not sure whether that's the final name. And it is actually being used for internally for product prototyping. And although Apple hasn't come up with an official statement or an official announcement rather on how they will want to offer this to the general public and how they are going to monetize this, the company is said to be aiming to make a significant AI-related announcement in 2024. And then secondly is that they are also in the middle of a lawsuit from the UK App Store developers. So more than 1,500 app developers brought about $1 billion class action lawsuit against the App Store fees. So they are essentially again criticizing the 15 to 30% commissions charged by Apple for using their app stores. And this is kind of similar to the lawsuits faced by Apple in other countries as well. So yeah, they issued and then 1.5 weeks ago, they issued their third quarter earnings. So I just give a brief run through. Their revenue was down by 1%, but this was better than the expected 2 to 3% drop. And the better than expected performance was mainly due to the growth in emerging markets, with sales achieving records in many different markets and categories as well. And then services was up by 8%, and this is a re-acceleration from the 6% growth in the second quarter. So for the outlook, they expect the fourth quarter revenue to be down by 1 to 2% year on year, which is similar to the third quarter as well. So during the call, we actually some analysts has actually asked them why they have not talked as much about AI as other companies, and they said that this is because they want to remain committed of only announcing the new products and services and features when they come to market. So yeah, that is the response. But however, they say that they have already doing research on various AI tools, including generative AI, for several years now. In terms of the earnings, the results were within our expectations, and services continue to be the main revenue growth as Apple leverage on its ecosystem strength as well as its installed base of 2 billion devices. So yeah, as the services segment continues to grow and scale with the installed base, this is going to benefit Apple in terms of their margins overall. So we maintain our neutral rating on Apple at a target price of $483. Then moving on to Amazon, the major news is that they held a biggest Prime Day ever in the company's history. So US online retail sales has actually rose by 6.1% year on year during the 2-day Prime Day period. So Amazon sold more than 375 million items during the event, and this was up from the 300 million items last year. So Amazon said this is the biggest Prime Day ever in the company's history. And then the second news is that they announced their second quarter earnings, which I have just run through just now, so I won't be running through that anymore. So yeah, for our rating, yeah, as I mentioned, we upgrade to the buy rating at target price of $175. Now, that's it for me. I'll hand over the time to Ambrish to talk about Microsoft.
Thank you, Max. So moving on to Microsoft, in July, Microsoft announced pricing for its Microsoft Copilot AI tool. So basically, it said that it would charge an additional $30s for enterprises per user per month to mainly use the AI tools associated with its Office 365 software. So like its AI capabilities, it includes like it could generate first PowerPoint draft from the content that we provide, or also it provides text prompts wherein we can generate report or edit a particular paragraphs, and also analyzing of spreadsheets. So the company said that it's still under beta testing with about 600 corporate clients, and public release it's not yet specified. So we believe that this should enhance Microsoft's competitive position, but it should not significantly materially contribute to its top line this year. Maybe going forward, it can contribute to its revenue growth. And also in July, a company released its fourth quarter results, which were within our expectations. And the results, they were mainly driven by its cloud strength, like Azure revenue grew by about 27%, and the number of paid users for the Office 365, they grew by about 18% year on year. In terms of its guidance for the September ended quarter, it expects its revenue to grow by about 8% to $54.3 billion, and with driven by Azure revenue growth of about 26%. So thus there is a slowdown in moderation for Azure revenue. So we expect that the moderation, it should have bottomed out, and the cloud spending should have stabilized, mainly because the growth rate for deceleration, it has significantly dropped. And in terms of its near-term headwinds, we believe that the weak PC demand, it should continue to impact its personal computing segment, particularly the Windows OEM revenue. So this is the revenue that it generates from the PC manufacturers who install Windows on their software on their machines, and also its PC accessories segment, like the devices segment. So this is going to be impacted by the weak PC demand. So overall, we have an accumulated recommendation for Microsoft. And to conclude for FAANGM, next slide, please. We expect that near-term weakness is expected to continue for the tech consumer goods like the personal computers and iPads, iPhone sales. However, we have upgraded the FAANGM to overweight mainly because there is recovery in digital advertising and there is the AI-driven cloud activity. And we believe that this should be the start to the sustained margin expansion for the cloud providers like Amazon, Google, and Microsoft. So that's all for FAANGM. I would now like to pass on to Glenn for OCBC.
Thanks, Amrish. Yep. So for OCBC, they recently released their second quarter and first half results last week, sorry, 1 week ago. So for their second quarter earnings of 1.71, they were slightly above our estimates. And with their first half PATMI at 53% of our FY23 forecast. And this came from higher net interest income and insurance income, which was offset by lower fee income and higher allowances. Their second quarter DPS dividends per share was also up 43% year on year to 40 cents. And as such, we have raised our FY23 dividends per share from 80 cents to 85 cents. So I'll just go straight to the positives. First positive being that their net interest income grew by 41%, which was led by a NIM improvement of 55 basis points year on year to 2.26%. And this is despite the loans growth remaining flat year on year. The NIM expansion was mainly due to the continued and rapid rise in their interest rates. However, quarter on quarter, it only grew 3% as there was a decline in NIM by 4 basis points as their assets growth was partly offset by the lower NIM, as higher funding costs outpaced the rise in loan yields. Nonetheless, they have also raised their NIM guidance from 2 to 2.2% to above 2.2%. But we do, think that they are being slightly safe on the safe side, so it might be even maybe hovering around 2.25 if it's possible. So for the second positive would be that their insurance income grew 26% year on year. And this was mainly attributable to the improved investment performance as well as the adoption of the new reporting SFRS 17 standard. For the negatives, first negative is that their fee income actually fell below expectations and it declined 10% year on year, as well as 5% quarter on quarter, as the higher loan-related and investment banking fees were offset by the softer wealth management fees, mainly from a decline in the customer activities amid a risk-off investment environment. But nonetheless, if you look at their wealth management income, it grew 56% year on year to 1.14 billion and contributed to 33% of the group's total income. Their wealth management AUM was also 10% higher, which was driven by continued net new money inflows. For the second negative is that their allowances was up and management has set aside 31 basis points of credit costs for the second quarter as compared to 12 basis points in the first quarter. And this was the second highest in 6 quarters, even though the asset quality is still benign, with their new NPAs during the quarter only at around 289 million compared to 174 in the previous quarter. And the NPL ratio was stable also at 1.1%. Their second quarter allowances rose by 250% year on year, mainly due to an increase in GPs, which were mainly set aside for changes in risk profiles, macroeconomic variable updates, as well as management overlays. So their management overlays currently is around 40% of their GP, which is around 1 billion. Notably, rest of the world NPAs rose 84%, and this was mainly due to the downgrade of a corporate account in the commercial real estate sector in the US, for which they see no systemic risk. For the third negative is that their current account savings accounts or CASA ratio fell 15.6 percentage points year on year to 45.3%. This is mainly due to the high interest rate environment and the move towards the fixed deposits. So we have seen this continued decline in their CASA ratio for the past few quarters already. So for the outlook, their loans growth was flat year on year in the second quarter, and this is falling below the banks as well as our expectations for FY23. However, management said that they do expect a slower pace of economic growth and have maintained their low to mid-single loans growth for FY23. For the fee income, the OCBC is positive on the broader outlook and expects the reopening in China to support their China Southeast Asia trade and investment flows. They have also mentioned that they do expect an incremental 3 billion increase in revenue that will come in over the next 3 years until 2025. And we could expect, so while it sort of fell short for the second quarter, we could still expect it to pick up sometime in the second half, and we could expect a mid to high single digit fee income growth for FY23. So for the commercial real estate office sector, they have given an update that most of it is to network customers in the key markets with a proven track record as well as financial strength, with overall LTVs low at around 50 to 60%, and most of their loans are secured, are fully secured. So overall, the commercial real estate office sector loans only make up 14% of their total loan book, with 2/3 of the loans to key markets in Singapore, Malaysia, Indonesia, and Greater China. And for the US, it only accounts for less than 1% of total group loans and are mostly secured by what they call Class A office properties, which is why they said that the increase in the rest of the world NPAs is not a systemic risk. So as such, we maintain a buy with an unchanged target price of $14.96, and we raise our FY23 earnings by 4% as we increase the net interest income estimates for FY23 due to higher NIMs as well as lower expenses, which are offset by lower fee income estimates. So that's all I have for OCBC. I'll now jump to the banking monthly. Yeah. So for banking monthly, I will do a sort of a brief overview and a recap of the three banks' results. And I think the overview is that their PATMI rose 35%, and this was mainly due to their net interest income and NIM growth. So if you look at the first box here, you can see that the net interest margins have continued to be boosted, which is a good thing for the banks, mainly due to the continued increase in the interest rates. However, this has led to one of the positives, which is the net interest income improving by 31 to 41% for the three banks. But this is also a sort of a double-edged sword. So we for loans growth, they have all sort of either lowered or maintained their guidance of low to mid-single digit for FY23. So for the fee income, it has fallen by 4% as an average for the three banks. But DBS is the sort of the odd one out, and they actually showed a growth of 7% year on year. And this sort of fall across the board for the other two banks is mainly due to a fall in wealth management fees. Yeah, and with card fees continuing to sustain its momentum. So I think the other key point I'd like to highlight is at this bottom red box here, where it shows the interim dividend per share. So you can see all three banks have shown this a huge spike in dividends, which is sort of to be expected as their income has grown quite a bit and they have to spend their capital, and 33 to 43%, and we could expect this to further increase in the second half of the year. So I think that's one thing that we could look out for moving forward. Now I'll go back to the monthly statistics. So let's go back to the next slide for the interest rates. Yeah, for excuse me, for interest rates, it picked up slightly in Singapore interest rates, at least picked up slightly in July, and the 3-month SORA was up 5 basis points month on month to 3.69%. However, it surged 265 basis points year on year, and this is the smallest year on year growth recorded in 8 months. But it's still, the July's 3-month SORA is still 7 basis points higher than the second quarter average of 3.62%. For the Hong Kong interest rates, it has continued to surge and reverse the decline from the first quarter, with the 3-month HIBOR up 26 basis points month on month to 5.1%. And this is the highest that the 3-month HIBOR has reached since December 2022. Okay, now moving on to the next slide. Yeah, for loans growth, the Singapore loans growth is continued to fall, and it fell by 5.02% year on year in June, and this is below our estimates of a low to mid-single digit growth for FY23, as the interest rates continue to increase and started to be more fully felt by the customers. Nonetheless, it showed some stability, and it was stable month on month, and this is only the second time it has been stable in 10 months. So for business loans, it fell 6.92% with continued dips in the building and construction segment as well as the manufacturing segment. And consumer loans were also down 1.85%, but it was There was one bright spot, which was the housing loans, which made up 70% of the consumer lending, and it grew 1.18% in June. For the total deposits and balances, it grew 3.62% year-on-year, and I think the important one will be the current account and savings accounts, or CASA ratio. It grew to 18.9% from 18.8%, and this is the first time that the CASA ratio has grown month on month in 16 months. So this is the first time in 16 months it has actually showed some growth. So it shows that it has sort of stabilized. The CASA ratio at least has sort of stabilized for the banks. Okay, now moving on to the SGX statistics. The preliminary SDAV for July rose 13% year-on-year, and this is the largest year-on-year increase since February 22 as the market sentiment started to improve. And the VIX has averaged 13.9, which is down slightly from 14 in the previous month. The DDAV fell 6% year-on-year, but it was up 5% month-on-month in June. For the top 4 equity index futures turnover, used to be top 5, but now the Nifty 50 has moved up, so we move it back to the top 4. It saw a slight dip of 3.5% year-on-year in July to 11.04 million contracts. This was mainly due to lower trading volumes of its Nikkei 225 as well as the FTSE China A50. Okay, now, next slide, please. So we maintain overweight on the banking sector and we remain positive on the banks. The bank dividend yields are very attractive, with upside surprises mainly due to excess capital ratios as well as a push towards higher ROEs. The stable economic conditions as well as rising interest rates remain the tailwinds for the banking sector. And I'd like to highlight that with SGX second half results coming out soon, they are also another beneficiary of the higher interest rates, as they will be able to benefit from their treasury income. So that's all I have for the banking. I'll now hand it over back to Max. Thanks.
Thanks, Glenn, and hi to everyone. We hosted audience analytics for guest webinar last week, so this is the Phillip on the ground. And just as a disclaimer, this content is not rated. So for audience analytics, their main business is the business impact assessment and recognition, whereby it generates revenue by charging companies fees for them to assess the operational process depending on which awards that they are opting for. So for example, if they opt for an HR awards, audience analytics are going to assess the HR processes in the company. So what they will do is that audience analytics is going to do a survey for the customers, employees, and then they will just run through the data using their own proprietary in-house research tools, and then eventually they will hold an awards events whereby all their customers are going to come together and see which one has won the awards. And then for those who have won, they are going to have the option to purchase a publicity fee where they can use the marketing materials prepared by Audience Analytics. So in terms of the revenue for the first half, it grew by 86% year-on-year, and again 85% of that comes from the business impact and assessment and recognition segment. So as you can see from the chart on the bottom, apologies if it's a bit small, but the gross margin and net profit net margin has actually jumped as well. And this is mainly because a lot of their costs are fixed in nature. So which means that as audience analytics attracts more customers and more orders from customers, it's going to generate an incremental bottom line. So then moving on to the other two business segments, which are the exhibitions. So exhibition is kind of a more straightforward business model where audience analytics is going to just rent a whole one business exhibition hall, and then they're going to organize the exhibition and they sublet all the booths to participants. So they will collect the fees for booth renting. And again, this is kind of the perfect example whereby if you rent one exhibition hall, it doesn't matter how many participants you have because the cost is the same. So if you utilize everything, it's good, but if you utilize only half of the exhibition hall, then it's better for audience analytics. And that is why it's kind of a fixed cost in nature. Then lastly is the business media. So yeah, as you can see, business has dropped quite significantly, and this is because audience analytics said that they are not really focusing on this as much, but they are still doing some business for this segment. So what this segment does is essentially the B2B digital and print media publications. And audience analytics are just going to charge advertising fees. This is kind of like your magazine business. So for the overall strategy, it remains the same as last year when they came for a webinar again. So they want to replicate the success of their top awards and to their other products, and they look to penetrate deeper in the markets that they are currently in. So they just want to attract more customers to purchase their awards, to purchase their services. Sorry. Then the reason why they are confident that they will be able to grow the revenue is mainly because there are increasing number of companies who see awards as a branding mechanism because it allows them to gain the exposure as well as the credibility. So audience analytics feels that it's quite confident actually that they think that their brands are quite well known, are more well known than the competitors. And so which is why they think that they have this kind of a high barrier of entry. So whereby customers will just opt for audience analytics rewards because they are more recognized globally in more geographic regions. So yeah, that's all for audience analytics. Now I hand over the time to Darren to talk about Prime US REIT. Thanks.
Yeah, thanks, Max. Yeah, so for Prime US REIT, their results were in line with our expectations at 50. Their DPU was in line with expectations at 50% of our estimates. So for their gross revenue, it was lower due to lower occupancy and slightly offset by increase in parking and recoveries income. For the MPI, they are affected by higher property operating expenses as there was a higher physical occupancy, like more workers returned to office. So for the distributable income, they were affected by a 34.9% increase in interest rates year on year. And 100%, they also changed their fee structure, management fee structure from 20% in cash to 100% in cash. Yeah, so as a result, their DPU was down 30% year on year. Yeah, so for the positives, Prime managed to extend debt maturities in the quarter to July 2024. So that's a 1-year extension, and this accounted for 34% of their total loans from their main credit facility. So as a result, they do not have any more refinancing obligations until then. And this will help them to give them more time to refinance their loans and secure refinancing for this upcoming loan expiry in July 2024. So another positive for them is that their gearing improved slightly to 42.8%. And right now they still have 80% of their debt either on fixed rate or hedged. And their effective interest rate increased slightly only on the floating portion by 0.1% quarter on quarter to 3.8%. And their ICR is still at 3.4%, which is above the 2.5% MAS gearing ICR limit to bring our gearing to 50%. And for them, they have a 5% and a 15% asset devaluation buffer before they hit the 45% and 50% gearing levels. So that is based on the 2022 year-end valuations. So if the year-end valuations decline by another 5% and 50%, then it will hit the 45 and 50% gearing levels. So for the negatives, their portfolio occupancy, it dropped by 3 percentage points to 85.6% because of the leasing demand remained weak during the quarter. It was down 22% year on year. So they signed 66,000 square foot in the quarter, and it's down. But on a quarter on quarter basis, it's kind of flat. It's just up 3.7%. So during the quarter, they managed to sign these reversions at the 9.5% rental reversion. So that's a good thing. And their strategy is to focus on net effective rents going forward rather than the headline rents. So a positive for that is that they managed to renew the lease of its largest tenant, Charter Communications, which accounted for 194,000 square foot in July for an extension of 3 years. So it's extended all the way until 2027 right now. And for the outlook, in the US office market, there's a return to office mandate kind of picking up pace. A lot of companies are implementing this mandate. So for Prime's assets, such as companies such as Goldman Sachs, they have already mandated a return to office. So this helped to bring Prime's physical occupancy to about 58% level for this quarter. And for Prime, their in-place rents are still 6.7% below asking rent. So this will, there's still potential for them to have a positive rental reversions going forward. Yeah, so with that, we maintain our buy call on Prime US REIT, but we lower our target price to 39 cents. This is fully based on valuations. Like Prime is trading at 0.25 times price to NAV. So we think we note that there's some headwinds in the US office space, but trading at 0.25 times we think is not reasonable. That's why we still maintain our buy call. And we believe that a lot of the negatives in the market have already been priced in. So the catalyst for Prime is improved leasing and a greater return to office, so bringing the physical occupancy higher. And some of the risks include Prime doing an equity fundraising to bring down the gearing levels. And right now, Prime is trading at a forecast dividend yield or forward dividend yield of 25 and 27% respectively for the next 2 years. Yeah, so that's all for me. I'll hand over time to Peggy now. Thanks.
Thank you, Darren. Morning. I'll talk about BRC Asia's results. The BRC had the third quarter update. Just some brief data were provided. Third quarter numbers were in line with our full year forecast. The gain was mainly at the bottom line of 11%. It's mainly driven by forex gain from a stronger US dollar. They hold some US dollars in the books, and they also write back provisions for onerous contracts. When steel price drops, they have 28 million of provisions that they can write back from the balance sheet. The volume has picked up from May after the safety checks were lifted at the work sites, but the management cautioned that the pickup in volume is still relatively slow. So they during this half they book more lower margin trading business. That means they did more trading business which are lower margin, and therefore that pulled down their margin slightly. Okay. On the construction sector is facing some credit default risk coming through. The ones that has been announced are the Tiong 8 construction and CKR, whose BTO project has been taken away from them by the HDB because of the long delays, and the HDB is appointing new contractors for that. That will have probably a repercussion down the road for other subcontractors that support CKR. And there are others like Botec, Hong Kong listed 1706 Hong Kong, that has 2 Singapore construction companies under the wing. These have also announced that they're facing default risk. So we asked BRC how are they coping with that. That for them, for the fixed price contracts, they are mostly insured through credit insurance, where they can at least collect 90% of those orders that they have delivered, and 90% of the proceeds for those orders that have been delivered. For the flexible price contracts, sorry, my mistake. I mean, for all the contracts that they delivered, they secured some form of credit insurance that ensured that they can collect at least 90% of the outstanding. And for the decline in steel price, which we are concerned that they might cause some customers to reject receiving the steel, hoping for lower prices. They told us that for fixed price contracts, they have insured, they have hedged the steel price, and for the those on flexible price contracts, those are most of it pegged to BCA in fluctuation index. Therefore, they likewise will also be insulated from any decline in steel price that will affect their P&L. So going forward, we still think net margin probably remain at this level, about 4.9%, as they engage in more trading activities. When the volume is take up is slow, the steel that they ordered, they turn it into the trading markets. Therefore, there's more trading for them. But still, on the demand side, the order books remains good at 1.34 billion. And BCA continue to estimate progress payments this year to rise by 9 to 20%. So we're not seeing demand is not issue. The issue is about the supply and the constraints that the construction sector is facing, besides cash flow, there's also insufficient dormitory beds that also lead to manpower shortage. So we are maintaining our buy recommendation with a target price of $1.99. Thank you. I'll move on to Pan United. Okay, Pan United also announced their results last Friday. We're maintaining our buy call target price 50 cents. The numbers actually beat our estimates. We had to raise our numbers, our full year forecast, but we're keeping our target price because our target price is derived from DCF, and with the higher sales, higher than our expected sales, they also have to probably incur more working capital this year to prepare for the higher deliveries. So therefore, there's not much change to our cash flow projections for Pan United. Okay, the results beat our numbers. The surprise thing is they also face the construction site delay in the first 4 months of this year, but somehow when things they are able to start delivery, they managed to catch up. For the 2 months of May and June, they managed to catch up, and the full first half volume was about the same as the first half of 2022. So during this quarter also, this half also, they have an improved product mix to deliver less of the standardized products and more of the differentiated products like the low carbon alternatives. So they therefore, and another reason for the higher margin is also because they provide batching services for HDB projects, and for this service they earn a service fee, so they don't have to incur costs for raw materials. So going forward, we think the margin is likely to hover around this level the second half and the next year. And the cash again improved, rose further to 18 million Sing dollars, and they generated very strong free cash flow of 3.4 cents, of 3 cents. So that means that the dividend can be intact for the full year of 2 cents for the full year. But on the negative side, Malaysia and Vietnam markets remain very weak for them. Okay, so management expects the delivery to pick up even more in second half, and prices for RMC will stay firm. The more residential construction work and the infrastructure spending would be the one that drive the demand. They also think that the industry adoption of their low carbon concrete solutions will rise, like what we hear from Hongdong Asia just now, 1 hour ago. The HDB is also thinking of how to incorporate requirements to use more low carbon concrete in the construction work. So this segment of the market demand should grow going forward, and with higher volume, that gives them operating leverage. So maintain a buy for Pan United. And let me move on to the Phillip on the ground. ST Engineering, we don't cover them. So this is just a non-rated report from the analyst briefing we met with them. Apologies, the chart is relatively small. I didn't realize it, but it's really so small until this morning. Anyway, I was trying to cram as much as we can into this table. As you can see from the table, defense and public security, we call it for short DPS, it's actually 67% of the total EBIT for the group. And for this business, for security reason, obviously, it's very opaque to us. So I find it very difficult to have a deeper understanding of this segment here. And also, this is the fastest growing segment, and the segment with the highest margin, EBIT margin for the entire group. Okay. Just a brief description of the results. The EBIT growth came mainly from a combination of a few exceptional items. Last year, commercial aerospace, they booked a 72 million as one-off gain from a pension restructuring. So this year, there's absence of that gain. So they think that, so they say that without that, the CA side would have a good growth as opposed to this negative 2.8% decline. For the urban solutions where they park the TransCore business, you recall TransCore was acquired. The acquisition was completed in March last year. They paid 3.5 billion for TransCore. Okay, paid everything with cash, with debt. Yeah. So this TransCore, they incurred a 21 million integration cost in first half 22. This first half, the integration cost dropped to 5 million. So they say there's a positive jaw of 16 million. Okay, then this half they sold off Satisfy. They incur a 24 million loss. The biggest headache for them is the satellite communication part of the business. The technology has moved ahead. They've not caught up. So now they are trying to do, they're doing a restructuring of the Satcom to cut away the different platforms that they have to just consolidate and put into one platform. So with that, Satcom lost 26 million in this first half 23, and they also pay out a severance pay of 2 million. So the loss in the USS was mainly due to Satcom. The defense, for the defense side, they divested US Marine at the end of last year. So last year, there were still losses at US Marine book in this DPS. US Marine, we don't know the number, but annually US Marine loss is about 40 to 60 million US dollar a year. So good for them. They don't have to, no longer have to face this loss. Okay. So I think the market is upbeat about this set of results, mainly for a few things. First, they announced they have a record order book, 27.7 billion in the books, of which 9.5 billion was secured in first half. So that shows the order win momentum is very strong. And they also, and 49% of these order wins came from commercial aerospace because of the pickup in the aviation industry. Out of this 27.7 million, 4.4 billion will be delivered in second half. So that also means that year on year they would see an improve in revenue for FY23. For the gearing wise, however, hasn't improved as much. From 2.2 times at the end of last year, it's now at 2.12 times. Net debt 6.2 billion. Management said they think they can make it come down to mid 5 billion by December 23. They are enjoying still better rates than most. The average cost of debt is now will be an average of low 3% for the full year and the mid 3% in FY24. I think the ST name helps in this regards. Okay, for the positive for this set of results is that also from the announcement is that they have received order to proceed for the New York congestion pricing project. They received it in June 2023. Originally, they thought they could start work for early this year. Now they think they will start in second half and then complete by second quarter of next year. So it will push back by 6 months. And they also think that the TransCore is still on track, like what they guided earlier, that will start to be earnings accretive from FY24, as TransCore will deliver this, like for instance, this New York congestion project is TransCore project. The project deliveries will be loaded in the second half. And of course, now they don't need to book any losses from US Marine. Okay, the negative of this as we walk out from the briefing is that Satcom will restructure. They will cut 20% headcount, so we think they might incur more costs in that aspect. And management insisted that they can generate 40 to 60 million annual cash savings from next year. This is cash savings. Yeah. The higher finance cost for this half, which has jumped like 2.8 times by 2.8 times, is likely going to be at this level for a while longer. So the bright spot for this for ST Engineering will be the commercial aerospace, where they would benefit from the recovery. Over here, they do MRO. They also do passenger to freighter conversion. And one part of it, they generate fee income leasing out the carriers, some of the carriers, and of course they also book earnings by selling the fleet of aircraft into this joint venture that provides this leasing business. Yeah. So that's all for ST Engineering. I move on to Olam. Okay, Olam, we also visited them, attended their briefing. The entire hall, about 80 of us, mostly bankers. Yeah, very few analysts. The Olam Group is a 5 billion market cap company right now. As you all know, they are into food sourcing, merchandising, two major segments. OFI is the food ingredients business that also have plantation in there. Olam Agri is really a sourcing business. So the Olam's business is not so much dependent on the price changes of the agricultural products. They are more closely correlated to volume. So last year they had a good first half. I think across the board, all the agri commodity players, the 4 big ones, the ABCD, they all had a very good first half 22 because of the war in Russia and Ukraine, where there was a perceived tightness in supply, and then there was a lot more stocking up in the market. So volume was higher. So this year they had a 5% volume reduction. The volume reduction is about equal for both OFI and Olam Agri segment. But revenue-wise, they fall further by 13%. Also, during this half, the congestion has been removed. Freight rates are down, so they earn less margin from benefiting from the freight rates, the delta in freight rates. Okay. The positive that the management flagged was that the Olam Agri IPO in FY 2024 is still intact, is still on track. They will be listed on SGX and Saudi Exchange. Then OFI will follow shortly after on this SGX and London Stock Exchange. In end of last year, they sold 35% of Olam Agri. At that time, they valued the entire Olam Agri at $3.5 billion US. That's about the same market cap that Olam has right currently. Okay. The negative is the company will still continue to incur reorganization costs. The reorganization meaning the splitting up the different companies to be listed. Okay, so and the gearing still stays high. This half, they actually had a net cash outflow, negative free cash flow of about 12.6 cents per share. Then they generate only ROE of only 1.3%. In this annualized ROE of 1.3%, ROIC of 7.5%. So that gives very little room for them for error, because of the finance cost is also slowly creeping up. Finance cost has almost doubled in this first half. Okay, the management thinks that customer destocking has come to an end, so they think volume might improve, but they are very cautious. They caution also on the end user demand with the weaker economy and the geopolitical tensions, or the climate changes, as well as the El Nino could also affect volume in the second half and next year. Thank you. That's all for me. I pass it on to Zin. Thank you.
Thanks, Peggy. I'll talk about technicals. So for looking at S&P 500, last week we continued a pullback and actually retested a prior horizontal resistance level. So this week wise, we are also currently at the short-term downtrend channel support. So we could see some sort of a bounce or a short-term rebound where the index could trade in form of a range. So for now, the immediate resistance lies between 4520 to about 4550, while the immediate support could be at 4380 to about 4450. Next slide. For individual counters, the first one is Citigroup. So for this, it's a technical sell at $44.40. Take profit levels at 41.50 and 38.30, while stop loss at 46.20. The stock last close at 44.57. So for Citigroup, there looks to be a breakdown of a very long consolidation triangle since March of this year. So and then looking at the chart wise, we also broke We also broke down a higher low at around 45.20. So if we do continue the current bearish momentum, we could see a potential retest of 41.50, which was two prior swing lows, which was formed in December of last year as well as March of this year. Then the next support level, if you go further down, would likely be at 38.30, which is another swing low in October of last year. Next slide. The next one is Walt Disney. So for this, it's a technical buy at 91.76. Take profit levels at $102 and $108. The stop loss can be placed at $86, and the stock last close at 89.02 on Friday. So for Walt Disney, it has been consolidating in a descending wedge pattern for a very long time, since start of this year. And then prior to the breakout, there was also bullish divergence building on the MACD. You can see higher lows form while the stock actually made lower lows in the wedge itself. So there was a breakout that took place last week. So with that, we could see some potential trend reversal to test 102 in the midterm, which was like a strong resistance from March to May this year. And then the next resistance level to look out for will be at 108, which would be a prior support that we broke down at the start of this year, and then a potential retest of the downtrend resistance line as well. So that's all for me now. I'll pass on time to Paul to talk about PropNex results. Thanks.
Thanks, Dane. So for PropNex, the results was below expectations, almost 30% of our full year forecast. So what has happened is basically for the last 6 months, maybe fourth quarter to first quarter, there's really a dearth of new launches. In terms of the positives, is again they are returning the surge in their free cash flow. They generated almost 30 million of free cash flow, and they are, as you can see from the dividends per share, I mean, it's just down 9%, although the earnings is down about 20%, because they are paying out almost all the profits, and they have another 140 million of cash in hand. So the payout, they're paying about maybe 40 plus million a year, and the first half alone they generated 30 million. Ignore the second bullet point, I know there's a typo there. The weakness is just if you can look on the left, the weakness is actually mainly on the private market. Private resale is down, project marketing is also down. So in terms of recommendation, we lowered our forecast, lowered our target price. We still have we downgrade to accumulate, mainly because the price actually did pretty well, and even though we cut our target price, it's still paying a yield, paying a dividend yield of 6%. And although not explicit, but I think they have some dividend yield targets. Although the payout ratio is quite volatile, but I still think that this stock, the management wants to keep a high yield, at least above 5%. I think this is what they've been doing quite consistently. So in terms of the outlook, I think for new launches, I mean, if you're a property buyer, there's going to be a lot of new launches coming up. So in the first half, there was 3,000 new launch. In the second half, there's almost going to be triple of that, almost 8,000. I'm exaggerating about triple is 9,000, but it's almost like 8,000 coming up. Last year was 4,000, so it's almost double of what was launched next year. So there's going to be a huge amount of choice. So don't expect the take-up rates for many projects to be as strong as what we saw in the first half. Private resale will still perform well, mainly because there's still a huge price gap. Okay, there's a price gap between resale and new launch. This is the average price. This not means every property project is a 58% discount, but this is just an average. And of course, there's also another phenomenon happening in the property market is that there's going to be like 19,000 completions. So this could also kind of push rental market down, but it will create a bit more vibrancy for more units for people to available for sale. So just one last key thing, which is like, so what's the key thing that's driving up the property market? So the key thing is going to be HDB upgraders, since most of the buyers now are Singaporeans and first-timers. And what will keep this momentum up continues to be the government grants. So government grants, if you're a HDB buyer, can be as high as 160,000, depending, there's like proximity grant, wage, depending on your income levels, but it can go up as much as 60,000. The long waiting times is also driving buyers into private, and also of course the high rental is also pushing buyers into rental into buying. I mean, that's mainly for the PRs and so forth. Next slide. So Thai beverage, so the title was the beer is still flat. So beer continues to be a weak spot for ThaiBev. So just to recap, the main profit for them, almost 80% is actually spirits. So beer is probably less than 10%. But the EBITDA line here, you see on the left, it looks a lot, but because there's minority interest, so that the impact on the PATMI isn't that large. But nevertheless, the numbers was below about 65. What the positive was there's a rebound in the spirits, volume revenue, and because they also raised price and the margins also climbed up. So the negative is beer, namely Sabeco. So Sabeco earnings was down almost 30%. So beer volumes, you can see on the left, is down by 11%. The issue with Sabeco, which is the largest beer brewer in Vietnam, is mainly because of the weak macro. So you can understand how bad it is, because if people can stop drinking beer. So what it means is that the industrial activity in Vietnam is exceptionally bad. GDP was supposed to be 6%, but first half only 3%. So because the export sector is very weak, so that's translated to weak consumer discretionary spending. So more macro situation in Vietnam rather than them losing market share and so forth. We maintain our buy mainly because of the valuations. So the share price is, I think, probably back is at the pandemic lows kind of value of price. Of course, the situation in Thailand doesn't help too. But again, for us, we have a buy mainly because of the attractive valuations. Next slide. So for HRNet, again, hate to depress everyone, but again also missed our forecast, mainly because my forecasting is not very good. But what has hurt them the most? So for HRNet, they are a recruitment company. They have two parts of the business. There's PR, means professional recruitment. That means these are more the permanent mid and upper tier executive kind of placements. Then flexible, it's the temp staff. So the one that's hurting them is mainly the professional recruitment, PR. Mainly because of technology hiring. I think the pullback in technology really caused like a 30% drop in earnings. And you can see it in North Asia. So North Asia was the one. It's not really, you can't really see visible, but in the earnings in our report, I think North Asia was down almost 30+%. So that was the biggest drag. Because 2022, the technology and semicon was hot, so there was a lot of placements. The positive is the flexible staffing. And there are two reasons for that, mainly because, and which is also the growth driver. So for flexible or temp, there's a move by corporates, because when the macro environment is uncertain, you do see more corporates preferring to use flexible staff rather than take on permanent. And for them, the other growth driver is that they are going overseas. So they are moving out of Singapore into Taiwan, Indonesia, Hong Kong. And when you want to build a flexible staffing, you need three ingredients. You need money, of course. So they have 300 million cash. So that's not an issue. Track record, of course, and also technology. Because they're so strong in Singapore. I mean, most of the 500 million that they do in flexible staffing revenue is mainly in Singapore. So yeah, they can hope to grow this outside. Negative, like you mentioned, just a steep drop in North Asia and Singapore permanent placement. We cut our earnings. We still maintain our buy. Again, we always like the business model. They are a net cash company, almost 300 million, and there's barriers to scale. So what we trying to say is that, of course, there's barriers to entry. You can set up a two-man shop and do recruit people, but what they have is scale. They have like 700 recruiters, almost 700. It used to be above 700, but they had some headcount reduction. And it's across 16 cities. And so when you're across cities, it helps because some of your big customers if they can find talent across borders, this will help them because they can cross-reference. Next slide. So I'll move on. This is my last portion. I'll move on to our usual Phillip Singapore Weekly. Quite a bit of news in Singapore, but mainly wages. So this is CPF. This is data on CPF contributions. So if you're an employee, that's good news because your wages is up 7%, but it's going to cause a lot of wage pressure for a lot of corporates. I think, like we highlighted last week, Sheng Siong and so forth, facing a lot of cost pressures, and that's eating up margins. Rail traffic continues to be strong, even though the reopening was more than a year ago. But you see the continuous strength in traffic because I think the return to office and increased activity is still occurring. This GDP, nobody cares about GDP, but just for your information, the government authorities did bring down the GDP forecast, the range. The most positive news in macro probably for the whole last week is the tourism numbers. So tourism continues to be strong, but the best metric was actually the Chinese arrivals are back in Singapore. So Chinese arrivals are Chinese arrivals are up 14 times year on year to 200,000, and this is double June. So our view is that the second half, tourism in Singapore especially would be exceptionally strong because the Chinese arrivals have come back. Of course, they're not back to pre-pandemic, maybe 30%, 40%, but you can see the month-on-month jump is like double the prior month. So this is building up very strong momentum. In the US, CPI was just beating expectations. So the whole narrative now is going to be gradual disinflation. Loans continue to be big. So although you see all the news about China loans contracting, but actually no, US is no better. So US have their first year-on-year loans contraction in almost 12 years. So we still have the view that no, US economy is slowing down. There was some Fed speak. So most of the FOMC members seem to suggest that they are going to keep monetary policy stable. So one say current interest rates or monetary policy is a good place. Another say we can be patient. So it's pretty obvious they want to hold interest rates in the next meeting on September. Next slide. So anyway, I'll just give you a bit of roundup because last week there was a lot of meetings that we went, a lot of results. So I can just tell you which one are the weak sectors based on my meetings. If you want more information, you can just ask. But so not to take too long the presentation. But the weak ones are consumer, of course, Vietnam that we mentioned. Electronics is weak. I think you saw AEM and NanoFlame results. Plantation is also weak, maybe because of year-on-year effect. Recruitment, I just talked about it, and rubber gloves is also still weak. Which sectors, based on all the meetings that we had last week, is strong? So workers' dorm is exceptionally strong. So workers' dorm, for those who don't know, is when the foreign workers come to Singapore for construction and oil and gas sectors. They are all placed in workers' dorm and industrial also. Sorry, industrial manufacturing. Demand right now is 434,000 roughly. I mean, nobody has the exact number, but based on some parliamentary comments, it's about 434,000 versus supply of 402. So why is demand so high? Demand is actually at record levels because of the delays in so many construction projects. So you see this huge influx of workers coming into Singapore, and then that's causing a big shortage. So and then as a result of that, room rates are rising from 300 per month per bed to above 400. There have been some quotes of almost 600, but it's about 400, and you get the additional 100, all drops down to the bottom line. Another phenomenon happening is because of the high rents. So there's also people moving out from maybe apartments and going to dorms because it's a bit cheaper too. The other thing is, of course, hospitality is a strong sector. I think we mentioned because the Chinese arrivals from China are coming back, and second half looks strong. Of course, right now with interest rates, with inflation still quite stubborn, I think what we think is that the base case is going to be a pause by the Fed in the next meeting in 20th September. But we think interest rates will remain elevated because right now the trajectory of inflation coming down or disinflation is going to be quite slow. And like we mentioned earlier, the Fed speak is a pause. I mean, they hit, Federal Reserve now is like a communication broadcasting station because every Fed official start talking every other day. So there are some events here for your reference, and of course we have quite a number of webinars. We have a Prime US REIT. We also have Capital Escort, but that's more for internal to TR and sales. Some of the large ones are Singtel and Comfort. Just go to the website and you can register. It's open to everyone. Next slide. This just to show the wages. So you can see pre-pandemic wage growth in Singapore was growing about 2 to 3%. Right now it's hitting almost 6%. I mean, on average, if you analyze it, the recent number is 7%. Of course, there's a higher inflation too in Singapore of 4%. You can see that you can see this sudden spike in visitor arrivals. So this is tourists coming into Singapore. So you can see this large spike. So most of it is arrivals from China, I guess, since they added 100,000 more month on month. Next slide. Okay, this is a very noisy chart, but just to, if you want to know what is, because inflation is so important now, so just to narrow it down, the red line is so inflation has come off quite a bit in the US, but most of it in the red line, but most of it is due to the green line, which is goods inflation. I think we know that. Just look at container rates collapsing. And of course, a lot of it is due to energy, but the worry now is, energy starting, oil price starting to creep back up, and shelter, which is the big component, isn't really moving up. So just worry that inflation might, disinflation is going to be slow. I mean, inflation might still be stubborn. I mean, based on the latest numbers. Next slide. Okay, I'll do one last one, just on nanofilm. So nanofilm is a FCVA carbon-based coating solution. Of course, 99% of the people don't understand, neither do I, but basically what they do is that they will coat any surface you want. So they will put a piece of carbon, strike the carbon in a vacuum changer, and then you will have droplets, but these are at atomic level, drop onto any surface, anything you want to carbon. So rather than do electroplating and then you have a lot of acid, and it's very of course it's not environmentally friendly, you use this for aesthetics and to have a better coating. So the results was bad. I mean, and they already had given a profit warning. So they had a 19 million profit in first half, now dropped to 8 million loss. The weakness was across. So you look on the table on the left. I will explain to you what is all this abbreviation, AMBU or that. Okay, so AMBU basically means customer Z, but I think customer Z is the largest mobile phone operator in the whole world. So I think we all know who that is. But that was the biggest drop for them, because AMBU, which is mainly consumers, is their largest segment. So I think smartphones is the one that really hurt them the most. Why it dropped more than the 41% drop more than smartphone sales is because of destocking. So as a supplier, when your customer stock is high, right? So they won't buy from you, they are continuing to sell, but then they won't order from you because their stock is high. So that you get a more intense drop for them. NFBU basically means lens. That's also weak because consumer. IBU means the equipment. So they do sell equipment too for this FCVA. And that is because customers are holding back in equipment spending. The issue also is that although they are in loss, they're still looking to build capacity. So I'm not sure how that's going to affect their P&L, because they even though they are losing money, they still want to expand capacity. Because their major customer, I think we know who is going to India, Vietnam, and exiting China. They are also going to Europe. Nanofilm is going to Europe because they see some demand there. But again, I'm not sure how the utilization is coming down, but they are still expanding. But anyway, in terms of their guidance, they said that second half will be better than first half, because it's always seasonal. But the problem is that the second half will be weaker than last year. So year on year, you should still expect weakness in then. And basically, they're just saying that the operating conditions are challenging currently. So the outlook for second half of this year will really depend on new launches. So I think if the new launch of smartphone does well, then that would do well for them. So our own comments is that I think just that they have a huge reliance on smartphones, and I think with that coming down, that hurt them quite a bit. The main upside for them is this thing that they're entering into China, which is EV battery bus coating. I'm not particularly familiar what that is, but it's basically to coat EV batteries, and this is the one that could really give them the earnings growth. But this is now still at test phase, and only at probably year end they might have some small ramp, because probably still a bit not proven whether they can ramp it up. But that's the most critical part for them in the coming years. Okay, I think I'll stop for now. I think our presentation this time around has been extremely long, so I think we just quickly run to Q&A.
Thanks, Paul. I'll take a couple of questions on the US side. So there is one on EVs and one on AI stocks. The first one is, hi, why did US AI stocks decline recently despite good results? So I don't have an exact answer, but I believe a lot of it has to do with them, running up quite significantly over the last 3 to 4 months. And it's just losing a little bit of momentum. Because they all did a sort of a re-rating earlier in the year after their first quarter earnings. especially after Nvidia came out with strong guidance for a lot of the AI stuff. Yeah, so also you gotta kind of understand that a lot of the AI stocks are still actually loss making. So they don't really, they're super volatile in terms of day-to-day price movements. Yeah. I think that's as much color as I can share on AI stocks for right now. I'll move on to the next question. What is Phillip's view on the EV sector? Is Chinese EV like XPeng and NIO in good stance with current macro landscape? Okay, so the EV sector is a bit segregated. You've got the half of the EVs, or more than half of the EVs in the world are actually in China. So it's, China is a huge market. And then the rest, mainly North America and Europe. When you're talking about XPeng and NIO, you're predominantly talking about the Chinese market because that's kind of where most of their sales are taking place. But within the Chinese market, the Chinese EV space is really dominated by BYD because they make a lot, they're not just your pure electric plays, but they also encompass a lot of the plug-in hybrid cars, which are considered electric cars. And they are also a lot cheaper compared to the XPengs or the NIOs because XPeng and NIO, they generally focus on a little bit more of the premium or higher mass market vehicles. So you don't really get the volume there. So if you think about just the Chinese EV space, you really just want to bet on the dominant player there, which is BYD. I mean, also Tesla is doing fairly well as a foreign company in China, especially there is quite a lot of they're doing well in terms of sales and deliveries in China because of their factories and all that. But if you look outside of China, Tesla is really, I guess, the biggest and most dominant player. Deliveries, the demand continues to exceed supply, but at the same time, they can continue to reduce prices and sort of maintain margins because of how they constantly are reducing their own costs for production. The EV, I guess the EV landscape is a little bit detached from the macro landscape right now because it's such a new sector, and there's a lot of regulatory tailwinds for it, and user adoption is really picking up, and so as people, I guess, as their traditional ICE internal combustion vehicles start to get a little bit older and they start looking for a change, then they start switching over to EVs. That really produces quite a boost to the EV industry, and for most consumers in the world, switching cars or actually getting a new car, it's, as much as it is discretionary in a lot of parts of the world, it's kind of necessary. So people are still going to buy cars, and if they switch over to the EV sector, and that's what we're seeing right now, it's just going to continue to thrive. So I hope that helps to answer your question on EVs. I'll hand it back to the rest of my colleagues for the other questions. Thank you.
Yeah, thanks, John. I'll take on the banking questions first. Okay, the first one, why did I change my mind about OCBC earnings from slightly below expectations on the morning note to above our estimates? Okay, so I think it's a bit confusing, but for the morning note one, it was based on the consensus estimates, as we only do yearly sort of estimates. So I was basing the second quarter on the second quarter consensus estimates. So maybe I will change that in the future to just reflect our call instead of the consensus estimates. Yeah. Sorry, a few more questions for me. What is the reason for the sudden dip in Singapore bank shares? So I think it's mostly because the bank shares actually shot up after the results briefing, all the banks' results briefing. So I think it's also a bit due to the profit taking from shareholders, because it has not seen these levels in quite a long while. Yeah. So I think that's because the results are so good, dividend yield is also very high. I don't think there's many other reasons to explain this. Glenn, who are the bank's network customers? Yeah, so OCBC likes to use this term network customers, and I think they did give a bit of insight to what network customers means. I mean, mainly what they say network customers mean is basically existing customer, right? An existing customer that has been with the bank, so they know the profile of the bank or of the customer, right? They have been in a relationship with the customer before. So this is not a new to bank customer. So for new to bank customers, it's a bit of a higher risk compared to this existing network customers, in their words. Yeah, so they're saying that these network customers are usually they are larger and they have sort of some existing relationship, so it's in a sense it's just less risky for the bank when they say that it's a network customer. I think this was mainly for the commercial real estate office sector that I spoke about earlier. What is the reason behind the high general provision of OCBC compared to the other two banks? Okay, I think the main reason for the high GP is because they are putting it back into management overlays, which is currently at 40% of their GP or 1 billion. So what they didn't really say explicitly why they suddenly increased this. It might have been the sort of what happened with their particular corporate account they had in the US regarding the commercial real estate sector. So that might have prompted them to actually increase their GPs just to be prudent. And maybe another reason is also maybe to match their peers, the other two banks, as well, to increase their management overlays. US mid-tier bank weakness. What is the probability of contagion impacting Singapore banks? Yeah, I think I've gone through this quite a few times, but I'll just reiterate my points being regarding the mid-tier banks in the US. So they are very different, I guess, from Singapore. Firstly, with what happened, they are slightly more risky. They're not as diversified as Singapore, and also as Singapore banks. And also, if you look at from their loans, the loans that they give out, it's a lot of it. All these regional banks in the US, it's a lot of fixed rate loans, and they can't sort of, if the interest rates go up, they are stuck at that rate which they have given their customers, which is definitely lower than the current interest rates. So if anything, they might not be earning as much, or they might even be losing. But in Singapore, it's they don't give a specific number or percentage on how much of their loans are floating rates, but they always say majority. So we take an average of maybe 70%. So that's how they can raise their NIM so high, by having this floating rate loans where they earn that spread from the customer. So even if the rates shoot up to record even higher than whatever it is now, they will still earn that spread. Yeah. So that's the big difference with Singapore banks. So I guess the probability of the contagion impacting Singapore will be quite low, because the banks are rather different. What is SDAV and DDAV? So SDAV stands for Securities Daily Average Volume, and DDAV is Derivatives Daily Average Volume. Basically, it just shows the volume for both the securities and the derivatives. I think that's all. Give me one second to just look through again. Oh yeah, sorry, there's one more on the IFAS. So IFAS, insight on IFAS short term and long term, and there's one more on the TA. I'll leave that to Zain. So for IFAS, we don't cover them, but basically short term wise, they are still expecting losses on their UK bank, the IFAS Global Bank, and they do expect it for the next year, until 2024 or 2025. So for short term wise, I think do expect that their net profits won't be as strong as it is, because they're still getting losses from their bank. But if you look at medium term, the Hong Kong e-pension revenue will definitely start to kick in 1 to 2 years time. So that will sort of boost their profits as well. And long term wise, that's where their IFAS Global Bank will, according to their words, they will start to reap the benefits long term. So yeah, so that's a short on IFAS. That's anything else? I think there's one more question I'm asking about to show the slide on OCBC. Show the first slide on OCBC again. Yeah, we'll just flash it on for a minute or two. But don't worry, our session is recorded. You can catch it on YouTube, so you can just pause it at the part which you would like to read again if this is too short for you. Okay, thanks. Hand it over to the rest of my colleagues.
Yeah, thanks, Glenn. I'll take over now. So the first one is what are your views on CityDev? Yeah, so CityDev, of course, they are hit by the property cooling measures in April, but for their most recent results, they are hit badly by interest expense because their hedging ratio is at 46% to fixed rate, right? So the interest expense year on year almost double. I mean, it did double, but it's almost double. So that really hit them. And on the headline numbers, you see like their PATMI is down by double digit by a lot, which I think 80 over or 90%, but it's mainly because last year they had this extraordinary gain of this divestment of the Millennium Hilton Seoul that brought that PBT to 1.6 billion. Yeah, so that was the reason why it is down. But if you strip that out, actually year on year their PBT still improved slightly. But other than that, the property developments side, their Newport Residences, they put it on hold because of the new cooling measures, and during the quarter they also recognized fully the Piedmont Grant contribution EC. Yeah, so that was why their revenue shot up a lot for property development side. Yeah, but for the hotel side, the hospitality side, even though the RevPAR, all this, and revenue grew by quite a big number, by double digits, but they still recorded net loss because of high interest expense and higher operating costs. Yeah, like the cost for labor, all these all increased, so that's why there's still losses there. But from an RNAV perspective, they are now trading at more than 50% discount to RNAV, so it's more of a value play. But we understand that yeah, it's challenging times for them. But we like the fact that they are pivoting more towards the property investment side, where we saw them acquire some assets like in UK St. Catherine Docks, which 90% occupied commercial property. Yeah, so all these are building the recurring income streams. So that's a plus for them. Yes, so that's our view for CDL. Yeah, the next one is please comment on Manulife with the latest update on halting the DPU. Yeah, so Manulife, they released their results this morning that they will be halting the DPU payments because of the breach in the the loan covenants. Yeah, so because of that, they kind of made a good faith payment to bring their financial covenants ratio, the unencumbered gearing ratios, because the limit is 60%, right? They breached it by 0.2%. So they made a small payment. So now it's 59.7%. But that doesn't really change anything in my view, because they still must seek the waiver from the banks before they can make any distribution. So as a result of this breach, as of this quarter, all of their loans are reclassified as current liabilities. So they need to get certainty. The banks would rather need to get certainty that Manulife will be able to pay off all these loans before they can pay off distributions for now. So yeah, they are in discussions with that. And then some of the options that Manulife has is, of course, the disposition mandate, where they get a mandate that they can dispose of assets easily, like quicker, because right now, if you want to dispose an asset, they need an EGM. But if they have this disposition mandate, it will make things much faster for them when they execute any disposals. And of course, there are some conditions to be met before they can do so. Yeah, so they are in discussions from that. And yeah, there's also in discussion with sponsor to divest Phillips to the sponsor. Yeah, so there's a little bit delay there as well. Yeah, so we are not sure. We can't really tell whether they'll be paying distributions at the full year end. But yeah, we need more details on the waiver of this the financial covenant. So that's the big one. Yeah, so we wish them all the best. Yeah, so that's my comments for Manulife. Yeah, hi. Darren, the fact that Prime US REIT manager decided to collect the base fee 100% in cash, does it reflect their lack of confidence in the REIT going forward? Not really. I think the reason why they wanted to collect their base fee 100% is cash is because they didn't want to really dilute the share base. But because you take it we compare it like for like last year, the share price was was around 80 cents and now it's 20 cents, right? So assuming the same management fee, and then if you account for the fee structure, rather you issue 4 times more shares now to 4 times more new shares versus last year if you were to pay in management fees in units. So that's the reason why I think they decided to collect the base fee in cash, because they didn't really want to dilute the existing unit holders. Because if you issue new shares now at like 20 cents, that is, and at 0.25 times price to book, so that is very, very dilutive for the existing unit holders. Yeah, so I think that is the reason why they decided to do the change. Country Garden rules, what's the implication for counters, or rather the listed counters like UOL, CDR, Google, and UL? Yeah, so Country Garden, they were over leveraged and then they invest mainly in a property development in more of the tier 2s or the lower tier cities, which saw a drop in demand. So the lower tier cities were hit very hard by the slowdown rather than the first tier cities such as Shanghai and Beijing and Shenzhen. So the local developers, if they are in China, most of them are focusing more on the tier 1 cities rather than the tier 2. So tier 2 and below. So yeah, so that's they're not as impacted as Country Gardens because of the slowdown and their properties, since they focus more on the tier 2 assets. Yeah, it's pretty, yeah, it's bad. But the local developers are focusing more on the tier 1 assets, which is not as bad for the demand in the housing. Yep. Prime companies like Goldman Sachs have mandated RTO, but for how many days, weeks? Yeah, so most of the US companies, when they mandated RTO, is for 3 days out of a 3-day return office week, like Tuesday, Wednesday, and Thursday back to office. So it's if you translate this, about 60%, minimum 60% physical occupancy. Yeah, so our views on Class and Parkway Life. Yeah, so the technical part, as usual, I'll leave to Zain. Yeah, so for Class, they are benefiting from the return to the hospitality, and the RevPAR is still continues to grow. And I think Paul mentioned earlier that the month-on-month travelers from China, so all these will help to will increase the demand and the performance, the top line of Class. But we do know that recently they issued a private placement and a rights issue, and it wasn't taken too well in the market. Like now we see the share price, it really it kind of not really crashed, but it dropped. Yeah, but we still have a buy call on Class with a target price of 120, because we believe that the demand for travel will continue, and that will continue to benefit their numbers, their financials. Yeah, for Parkway Life, we do not cover them. Yeah, so I won't comment on Parkway Life. I think I see one more. If the US economy is slowing down, how does it affect Prime US REIT? Yeah, so if the US economy is slowing down, it will affect the demand for all this office space, like the companies, if let's say they are cutting costs and they are slowing down hiring, then the need for office space won't be there. So they might the leasing demand might slow, and the demand for office space generally will be weaker. So that is how yeah, in simple terms, the US economy will kind of affect the US Prime US REIT going forward. Yeah, I think I better hand the rest of my team for now. Yeah.
Okay, let me take over.
Yeah, thanks.
Thanks, Darren. Okay, there's a question on your views for Sembcorp, Seatrim, and Delphi. Okay, Sembcorp is we are positive on them. because they are an energy play in Singapore market. And if you read recently, EMA has been talking about even importing energies from regional countries like Indonesia and India. Not these two are not the so often so fickle-minded, not the best supplier we would like to have, right? So it shows how tight our energy demand and the supply is. So, and that was probably going to last till 2025. So therefore, Sembcorp's earnings will be underpinned by the strong energy margin and profit going forward. So we're still very positive on Sembcorp Industries. For Seatrim, that is a bit we don't cover them as well, but we like to highlight that they have a short-term debt of 2.2 billion in the 2.4 billion, which will probably have to be refinanced. In the first half 23 results, a lot of these debts be turned into the current liability. So we think there might be a need for them to seek some refinancing for this. And the Seatrim is still thinking about their strategic review for the merger. So the decisions will only be out by end of the year. So as to how much that will cost them, how much they need to cut in terms of headcount and capacity is still an unknown. So, and on top of that, they have started corruption investigations on Seatrim's business in Brazil. So all this are not going to be any positive news for them in the near term. Yeah. For Delphi, we attended the analyst briefing. They have a very strong first half, but if you split between first quarter and second quarter, most of the profit came from first quarter. Because the Lebaran and the Valentine's Day will all fall in the first quarter, and during these periods, usually a lot of very robust sales. But second quarter, you can see the revenue has slowed down. And the few things that Delphi has benefited from is since post-COVID, there's a lot of shopping has been shifted, from hypermarket to supermarket, or even the mom and pop stores have been moved to convenience stores. So convenience stores have been doing very, very well. And now even in convenience store, you can sit down and eat the ready-to-eat meal, heat it up and eat it. So a lot after COVID, most people like to shop in proximity to their home or office. So Delphi chocolate bars have enjoyed that lifts in buying. And Delphi also has launched healthier products that caters to the Gen Z and the millennium. And the construction of highways in Indonesia actually means that you have a lot more petrol kiosks along the highways, and petrol kiosks usually come with the convenience stores, and there's a lot of just pick up your food along the way. And Delphi has also moved into advertising using TikTok to target the younger people and the impulse buying. But well, the thing to note though is that first, besides the second quarter lower revenue, although second quarter is typically a weak quarter, but still the decline from first quarter is quite sharp. The Lippo Mall told us that the consumption demand from the low to mid income group has actually in Indonesia has declined quite sharply. So and Delphi has also moved into producing smaller packaging, so that the smaller packaging actually gives better margins to target this segment. So it's actually it's something to watch, that going forward the Indonesian the slowdown, the consumption spending might slow down. Although we hope the election could help, but so far we haven't seen any evidence of an election boost to Indonesia election boost to food spending. That's all I have for the three stock. Thank you. I hand back to the rest of my team. Thanks.
Yeah, I'll quickly do some so that we have time for the technicals. I'll just run some. Has HRNet maintained its dividends over the years? Is it increasing? Do you see recovery fairly soon? So HRNet has actually returned quite a lot of capital. The number of shares out there is probably roughly 1 billion. So they paid 8 cents over the last 2 years. So they paid almost 80 million back to shareholders. And they also announced a 30 million share buyback. So 80, almost the return, almost 100 million. There's another 110 plus million. So they do return a lot of the cash. So that's the positive. In terms of recovery, I think it's going to be flat first half versus second half, but year on year is still going to be down. So the recovery won't be so soon because last year they might have over-earned a little bit because of the strong technology sector. I'll move on to the next one. Please comment on AEM results. So AEM results, there'll be a briefing at 3 p.m. So I'll just tell you what the announcement make. Just that in the second quarter, the earnings is down 90%. So this is not like CDL, there was an exception again. This one is really operationally 90% down. PBT was only 5 million because they only disclosed PBT in the first quarter. And they also lowered their guidance from 500 to, I think, 470, 460. So they lowered their guidance revenue for the year by 10%. So in terms of the share price, so the share price used to be 340. Then they already announced the very weak guidance in February. So the share price dropped to 280. But because of the US doing so well, semiconductor, the share price shot back up to $4. Even though they already guided that was weak. So now it's about 3. So my own guesstimate is that this stock probably needs to drop back below $3 or at least 280 to price in this weakness, unless you assume there's going to be a sharp rebound in semiconductor. But so far, it doesn't seem to be, for the second half. Otherwise, they wouldn't have guided down lower. So that's the next one. Sorry. Hypo, with the US dollar strengthening against Sing's dollar, which sectors tend to be hit adversely? Nothing really stands out. So I struggle a little bit. I can tell you who benefits. I mean, electronics will benefit, but who suffers? I think would be probably the importers into Singapore. So it's probably going to be some of the retailers. But I struggle. So I don't really have a concrete answer like who is the main one who will be hit. Hi Paul, also speaking to Singapore companies, what is your view of the current level of demand for AI? For AI, is it sustaining? Okay, for AI, I don't think anyone mentions about AI. So I don't really current view of demand for AI. I don't really see is this sustaining. No one talks about AI. Sorry, so I don't. It's not so much. Hardly any company talk about it. Money for marketing jargon. I don't think there's anything concrete. Hi, Paul, the supply issue still prevalent? No, there's no more supply. Sorry, there's no more supply issue. The probably is a demand issue. There's because the corporate is cutting back because the confidence level is down, and then consumer weak. So all the consumer players are cutting back on inventory and so forth. It will be better second half compared to first half. But most are expecting recovery in 2024. But I have my doubts of, because even if they recover, how much can they recover? The thing is because at the time the US might be at their peak rate of slowdown. So if you assume there's a very sharp slowdown in the US in the first half of 2024, I think the semiconductor recovery could actually be pushed back into maybe second half of 24. My own thoughts are, Hi, any views on semiconductor glut were a bit? Again, the same thing. I mean, most of the companies are guiding recovery in 2024. There's virtually no basis for that. I mean, they just assume that there will be some recovery. That's it. Of course, the first half of this year is exceptionally weak, so you might get some pop. But I think a more meaningful recovery is probably maybe in second half of 24. That's my own guesstimate. Okay, I think I would. I think I better hand back now to Zane for the technicals. Because we're running out of time.
Okay, thanks, Paul. Let me just share my screen right now. Okay, so the first one would be this HSI or Management Index ETF. So currently we're seeing some pullback. Actually today it looks like there's a possible break of this uptrend support line as well. So with and also a break of this recent resistance around 4.2. So if that possibly we do continue some downside, the next support level to look at probably around 4 over here. Yeah. Then next one is Tencent. Also for Tencent today, similar story. There's a possible breakdown of this uptrend support line as well. So the key for now would be likely to see whether the recent lows around 320 to about 325 over here is able to hold this range over here. If not, then there's some possibility of some further downside to try and test this swing lows around 310 over here. The next one is JD.com. So for JD, also similar story. There's this the main trend is currently this uptrend channel over here, but today there's a possible breakdown of it. So if price is unable to recover back above, I think we could see some downside to trend to retest about 138 over here, and then followed by some swing low at 132 over here. And last one will be Ping An Insurance. So Ping An currently it looks like it's trying to test the key support over here again around 48.5. So it's important to see whether price is able to hold over here similarly to the rest of the counters mentioned earlier. If not, we could see some further downside to try and retest the next window, which is around 47, as well as around 46.5 over here. Yeah. So that's the next support level to look at. Yeah, in general, Hang Seng is quite weak for now. Yeah. So let me just show the chart of the index as well. So currently, currently quite bearish because recently we tried to break over this 19.3K level over here. We had looks like a false breakout when you look at the blue color channel. So with that, we also broke below this key level, which is around 19.3K. With that, bearish movement actually continued down. So it looks like it looks like possibly we're trying to test the recent lows, which is around 18K to about 18.3 if the recent momentum actually continues. Okay. Okay, then next one is the 3 local banks. So for first one, I'll start off with OCBC. So for OCBC, recently we have a pullback also after the XD. So currently it looks like price might be trying to test around 1230 to 1240 region, which was like a prior resistance level over here. As far as when you look at the main uptrend channel over here that is trading at, looks like we should be quite near the channel support over here as well. Then next one is DBS. Okay, for DBS currently, price is trading in a bit of a range over here, currently meeting resistance around $34 level. So $34 was like we last reached this level was around February of this year. So over here, I expect some resistance of a pullback. I think first level of support look at possibly around 32.80, and then the next level of support, the stronger one is around 32.40 over here, which was like this resistance level we broke out of. And previously there was like a build up that took place over here as well. And last but not least will be UOB. So for UOB, the chart wise a bit similar to DBS. Also met resistance around the 29.30 level here. Currently, we are retesting a one level of support, which is around 28.50 over here, prior resistance. So if you're able to hold this level, I would think that we might continue to trade in a bit of a range. If not, then I think it might go and search for the next support level, which is around 27.80 over here. And that's the next support level take on. Okay, then I'll move on to some the other Singapore counters, which is first one is capital investment. So for now looks not very good, quite bearish. So we actually there's after this range over here, you see the break of this 320, 325 key support over here. So prices went to test the previous resistance around close to $3 over here. So that's one level of support over here, but with the bearish momentum, there could be some further downside if we do continue on from this trend. Yeah, so the next support level to look at will probably be around 290 over here, which was like a swing low in October of last year. Then this might be a better support in my opinion. The next one is Escort. So for Escort, currently we broke down on this key uptrend support line. So with that, we are testing first level of support, which is around close to about around the $1 mark, which was like a swing low in May this year, as well as a prior resistance. So this is the first level of support that we could see some bounce. If price is unable to hold, then you're likely to search for the next level of support, which is around close to 95 cents. Another swing low over here. This was in March this year. Okay, then the next one is selling integrated commercial trust. So for this, currently looks like doing a retest of this wedge breakout over here. So with that, there could be some support coming in close to about 188. So this was like a short-term resistance over here, which price broke above subsequently. And then this 188 level also retest this uptrend support line over here as well. Yeah, so there could be some sort of bounce to take place over here if there's some support over here. Okay, then moving back to some of the Hong Kong counters, Alibaba. First one, Alibaba. Looks like we are still trading. We might be still trading in this uptrend channel over here. So after today wise, it looks like there's a break of this $93 level. So over here there was some support over here. Then price actually broke below it. So with that, the next support level would be around closer to 88 over here, which is another swing low. Yeah. Then next going down a little bit further could be around 86 over here, which is this channel support. Yeah. So if we are unable to recover back towards 93, then I think price could see a little bit more downside, try to test the next support. Yeah, which is around 88. The next one is HKEX, Hong Kong Exchange and Clearing. So for this, I think we are still bounded by this main downtrend channel over here. So for now, we are testing our first level of support around 303 over here. So we see whether price is able to hold. If not, then with the current bearish momentum, if price is unable to hold, then we could see some test of the lower level, which is around 208, mid 280 over here. Okay, then last this will be Meituan. Okay, for Meituan, also below this key level around 137. So previously it was like a strong resistance overcame over here. Then when there was a bounce that took place, however, price was unable to hold with this price action over here. So with that, looks like we might be looking to test a lower support, which is around 127 over here. Prior resistance over here, then there was a swing low over here as well. Yeah. Okay, then next one, First Resources. Okay, so for First Resources, currently looks like a double top took place at 160 over here. So might be losing a bit of momentum if we stay at this channel support, which is around 154. Also like prior resistance over here. So with that, if price continues to pull back, could see some retest of around 150 over here, the recent swing lows. And next one will be around 146 over here. Okay, the next one is REX. Okay, for REX, price resisted at this very strong downtrend resistance line previously around 18 cents. Then pulled back. Today we broke this support, which is around 17.3 cents over here. So with that, likely price might be testing a support around 16.3 cents. So this was an uptrend line support, then also previous support and resistance as well. So this will be a key level to watch out for. Okay, the next one is venture. So for venture, after the gap down last week, we actually traded in a range over here. So for now, there could be still a little bit more downside if we were to test this channel support over here. That will bring us to maybe around 1350. Yeah, but for now, could be trading in a bit of a sideways direction. If we find support around 1370, then our current resistance will be around 1420, 1430 over here. Okay, this one Broadcom. So for Broadcom, currently quite bearish. Put down of this range as well as the uptrend support line, then price actually traded lower. Also broke this swing low around 840s over here. So I think currently we'll go and test the next support around 820 over here. We see whether we find out support. Sorry. If this doesn't hold, then we'll likely go and search the next support, which is around 785 over here. Okay, then next one, Hong Leong Finance. Okay, for Hong Leong Finance, looks like we could be breaking down of a wedge, this rising wedge pattern over here. And price, I think if we look at the horizontal support wise, it's still holding around 249, 250 this level. So unless that is broken, then that will confirm more downside come. But for now, looks like the range is still holding over here around 249. Then resistance will be probably around 253 over here. Okay, next one, Raffles Medical. Okay, for Raffles Medical, looks like we are testing the 130 support over here again. So over here it's in a bit of a range. It's key that this level must be able to hold. If not, like we could go on to see maybe price test 127 over here, the next support level. Then the next support below it will be around 124, around 124, which is this. We have this gap over here as well. Okay, then next one will be Salesforce. Okay, Salesforce currently looking bearish. Trading after breaking down this 220 support, just in this downtrend over here resisted by this trend line. For now, could be finding a bit of there could be a chance that we find a bit of support from this strong support over here around 205. Previously, we had this consolidation that took place over here. And price currently looks like there's some support coming in over this level. So if price managed to break out above this trend line, that will confirm the support over here. Then current resistance wise, I think we might see around 214 over here, which is this level we come from. Okay, then next one will be ESR Logos REIT. Okay, so for this, I think we look at the bigger trend wise, is actually just trading in a downtrend channel over here. Price try to sideways a little bit. So the key is like whether we're able to find support around the 32 cents level over here, which was this resistance when there was a very long period of range. So if that happens, then there's a chance for price to actually trade higher to get out of this channel. If not, I think likely we could see continued range between 32 cents about 34 cents currently. Okay, next one, Keppel Pacific Oak. Okay, currently I think now nothing much, just still trading in this range, very big range over here. So I will expect that to continue unless there's a breakout or breakdown. So key level 13.5 cents, 31.5 cents, sorry. And then support is closer to about 27 cents over here. Okay, and prime US REIT. Okay, for prime US REIT, we actually retested this range breakdown over here. So previous support, now turn resistance close to the 20 cent mark. Price retested, pulling back a little bit. So for now, I think could be just consolidating a bit of a range over here. If there's some weakness, it might go and retest the recent swing lows around the 18 cents level over here. Then we see how price reacts, whether there's some support coming in. Yeah, but I think for now, price, yeah, just a lot of range is going on over here. Okay, TA for Genting Sing. Okay, for Genting, currently looks like there's still some resistance. So this downtrend channel looks like it's still holding over here. There's also price last Friday we actually tested some swing high resistance around the 96 cents level over here. So I expect some resistance for now. Price might pull back a little bit. If it's still gonna stay within the channel itself. Current near-term support could be around 92.5 cents, about 93 cents. Given that it was these swing lows supports over here previously. Yeah. So I think, yeah, if we see some sort of pullback, I think there's some there might be some range trading going on here. Next one, C07. C07, Jardine CNC. So for Jardine, I think the trend is a range. There was a previously I mentioned I think there was a range going on over here, but it looks like the trend started to weaken. See lower highs and as well as lower lows starting to form. So it's a bit of a downtrend taking place over here right now. So if the trend actually continues, we might see some potential retest of this $32 support over time. But for now, I think just trading in this channel over here. Okay, then TA for Apple. Okay, for Apple, the major thing that happened was that the breakdown of this the main uptrend channel over here that took place for since the start of the year after the results. So price actually just went down and starting to sideways a little bit. So some support around at 177 currently. Resistance is around 180 for now. So with that, if 177 we find some support, likely go and test 180 again, then next resistance around 183 as well. So we might form a little bit of a range, but if price fails to support at 177, next support level will be around 175 to possibly close this gap. And 175 previously was like a swing highs over here previously. So that would be a key level to watch out for as well, to see whether we're able to find some support over there. Okay, then I just cover one last one on the Keppel Corp. Okay, so for Keppel Corp, currently it's still in an uptrend over here. Price around 730, the price starting to pull back a little bit. See whether we're able to find some support at some previous resistance level around 695 over here. If this level is unable to hold, then price might come back a little bit lower to try to fill this price gap over here, and we test the prior support around 685 over here. Then this might be a better support. Yeah. So for Keppel, if you're looking at the midterm wise, it's still trading quite nice uptrend over here, but short term wise, just a little bit of pullback over here. You can see decreasing volume over here as well. So I think that's all from me today. Pass back the time to any of my colleagues if they have anything to add on. Thanks.
Okay, I think we really hit the 115. So so I think we did taken more than 2 hours at everyone's time. So if you have further questions, we will try and post some of those questions in our P3 community, and then hopefully you can read it from there if there are some that have not been answered. We'd like to thank everyone for your time and especially the questions. Thank you, everybody. And sorry, extended a bit longer today. Thanks.